At tax time, car claims are one of the most misunderstood deduction areas in Australia. Many people think that if they drive to work, they can claim their car. But that is not how the system generally works. This video explains D1 car expenses in simple terms. We will cover what D1 generally refers to, when car travel may be relevant, the two main methods often used by individuals, and a simple case study. This video is general education only. It is not tax advice, financial advice, legal advice, or personal advice. D1 generally refers to work-related car expenses claimed in an individual tax return at a broad level. The key idea is this: a car claim is not based on how much you drive overall. It is based on work-related car use. That distinction matters. In general, ordinary travel between home and your regular workplace is usually private. That means many people cannot claim their everyday commute. However, some travel during the course of work may be different. For example, travel between work locations, travel to visit clients, or travel to carry out income-earning duties during the day may be work-related. There are also exceptions and special cases in the tax law, but in this video we are keeping to the general rule. So the first question is not, how much did I spend on my car? The first question is, which kilometers were genuinely work-related? For many individual taxpayers, there are two commonly discussed methods for claiming work-related car expenses. The first is the cents per kilometre method. The second is the logbook method. Let's start with the cents per kilometre method. This is the simpler method. At a general level, it allows a deduction based on work-related kilometres multiplied by the ATO rate for the relevant year. For the 2025 to 26 tax year, the commonly used ATO rate is 88 cents per kilometre. Under this method, the claim is capped at 5,000 work-related kilometres per car per year. That means the maximum claim under this method is calculated using no more than 5,000 work kilometres. This method is designed to be simpler. The cents per kilometre rate is intended to cover the car's running costs. So people generally do not separately add fuel, insurance, servicing, registration, or depreciation on top of the cents per kilometre claim for the same car. Let's use a simple example. Imagine someone has 3,200 work-related kilometres for the year. Using the cents per kilometre method, the calculation is 3,200 multiplied by 88 cents. That equals a deduction of $2,816. That is a deduction, it is not a refund. If the taxpayer's marginal tax rate is 30%, the approximate tax effect may be $2,816 multiplied by 30%. That equals about $844.80. So a car deduction of $2,816 does not mean $2,816 comes back as cash. It means taxable income may be reduced by $2,816, and the tax effect depends on the person's overall tax position. Even though the cents per kilometre method is simpler, records still matter. The taxpayer should still be able to show how they worked out their work-related kilometres. That may include diary records, trip records, or other evidence showing how the estimate was reached. Now, let's move to the logbook method. The logbook method is more detailed. Instead of using a flat cents per kilometre rate, it looks at actual car expenses and then applies a work use percentage. That work use percentage is usually based on a valid logbook. At a general level, the logbook records work-related travel over a continuous period, commonly 12 weeks, to establish the work use percentage. That percentage can then be applied to total car expenses. Those expenses may include items such as fuel, servicing, registration, insurance, repairs, interest on a car loan, lease payments in some cases, and decline in value depending on the circumstances and the rules. The logbook method is more detailed, but it can produce a larger deduction where work use is high or total car costs are high. Let's use a simple example. Imagine total car expenses for the year are $9,500. Now imagine the logbook shows that 60% of the car's use was work-related. Under the logbook method, the deduction is $9,500 multiplied by 60%. Again, that is a deduction, not a refund. If the taxpayer's marginal tax rate is 30%, the approximate tax effect may be $5,700 multiplied by 30%. That equals about $1,710. This example shows why the logbook method can sometimes produce a larger deduction than cents per kilometre. But that larger deduction depends on stronger records. The logbook method usually requires more evidence. That may include the logbook itself, opening and closing odometer readings, and records for car expenses such as receipts or invoices. So how do the two methods compare? The cents per kilometre method is simpler, it is easier to calculate, but it has a 5,000 kilometre cap. The logbook method is more detailed. It may better reflect higher work use or higher vehicle costs. But it also requires more record keeping. This does not mean one method is universally better. It means the method has to match the rules and the records. Now let's bring this together with a case study. This is a fictional educational example based on general tax principles. Imagine Priya works as a community support worker. During the day, she drives from one client location to another. She also drives from the office to client visits and then back to the office. Those trips during the course of work may be different from the ordinary trip from home to her regular workplace. Now imagine Priya keeps enough records to identify for 1,000 work-related kilometers for the year. Using the cents per kilometer method, her calculation is for 1,000 multiplied by 88 cents. That equals a deduction of $3,520. If Priya's marginal tax rate is 30%, the approximate tax effect is $3,520 multiplied by 30%. That equals about $1,056. Now imagine Priya also has total car costs for the year of $8,800. And imagine her valid logbook shows work use of 58%. Under the logbook method, the calculation is $8,800 multiplied by 58%. That equals a deduction of $5,104. If Priya's marginal tax rate is 30%, the approximate tax effect is $5,100 multiplied by 30%. That equals about $1,531.20. In this example, the logbook method produces a higher deduction, but that only works if the records support it. And again, the key point is not just how much she spent on the car. The key point is which method applies, how much of the car use was work-related, and what evidence supports the claim. There is one more point worth repeating. D1. Car expenses are not about claiming every kilometre you drive. And they are not about turning personal travel into tax deductions. The system is trying to separate private car use from income-related car use. That is why the quality of the records matters so much. So let's finish with the core ideas. First, ordinary home-to-work travel is usually private. Second, work-related car claims are about work-related kilometers or work-related use, not total driving. Third, the cents per kilometer method is simpler and capped. Fourth, the logbook method is more detailed and based on actual costs and work use percentage. And fifth, a deduction is not a refund. It reduces taxable income, and the tax effect depends on the person's overall tax position. This video is general education only. It is not tax advice, financial advice, legal advice, or personal advice. Tax outcomes depend on individual circumstances. So always check official ATO guidance or speak with a registered tax professional for your own situation. Click subscribe to Finance Systems Explained Australia and keep learning how Australian finance systems work.